and you drive about 45 minutes east of Phoenix, and suddenly you just go from like city to desert to like this beautiful rolling hilly kind of cliffy area, and then you kind of go through this crevasse and you enter this beautiful kind of range with these rocks and whatnot. And there at the top of all this is this kind of like plain shaft, right? There's a couple of large pieces of iron that have clear lifts going down to the ground, but you don't think anything other about it. So that's where the actual mine is located. And I said, well, you know, I want to go down into it because it's the deepest mine in the Americas. It's about 1.5 miles deep. Wow. Mm-hmm. So we went all the way down there, and you get down there, and it's kind of like, I don't know, you go to like a new library, right? It's all concrete and lit up by fluorescent lights and everything else. And if you didn't know you were 1.5 miles in the ground, you might think you're like at a casino or, you know, someplace without windows. Yeah. But that's where it stops, because there is no mine being built, because they don't actually have the right to the land right now to build where the actual copper veins are, right? So this is going to be a copper mine. It's going to have, like you said, be producing the most copper in all of North America. And it sits below this Native American site. It is a campground actually owned by the Forest Service, but the San Carlos Apache tribe say, this has been our land for time in perpetuity. That I was actually talking to the guy who is one of the former Apache leaders, who's now leading the kind of charge to say you should not give this land over to Rio Tinto. The United States should hold on to this land. And yeah.
Well, so there's tension. I want to bring Joel Weber into it because Joel, you know, the reason this is such an important story is we talk so much about electrical vehicles, EVs, and we talk about lithium, that's so important, but actually copper is really important when it comes to EVs.
And we need a lot of it.
Yes.
Like so much of it, like you need like maybe a big gigantic mine with like the biggest deposit in the US.
But like Joe maybe visited.
Yeah, exactly. But you know, I think it does speak to when you mentioned some other materials there, some metals there, like look, like the U.S. has really never been at the forefront of getting this stuff out of the ground and making it be a supply chain that could end up in electric vehicles. Yeah. I think that really changed with the new incentives from Washington. Mm-hmm. And this shows how there's this reality that has yet to meet where, you know, we might end up in the future. But Joe, in this specific example, you know, how likely is Rio Tinto going to be even to get this copper out of the ground anytime?
I mean, if you assume that the United States government does end up approving the land swap, and it is on hold right now because the Biden administration said, wait a minute, we feel like some of the licensing wasn't actually done correctly. We feel like some of the environmental impact studies were not done correctly, so maybe we should redo those. Even if they suddenly said, you know what, we're going to reverse that and allow for the swap, it would still take 10 years before Rio Tinto is actually pulling copper ore up out of the ground. So, I mean, it just reminds us that mining projects take minimum 10 years to get up off the ground. And this is the problem. I was saying on Twitter just yesterday, you know, the Biden administration has been front and center talking about the materials being domestically produced. And even though most people don't think, oh, energy transition, we need to talk about the mines. I mean, this is like constantly being talked about in the White House and being talked about around Congress. Everybody's for this, but you get into the complexities of this situation with resolution and you see why it is so difficult. And the problem that we have, right? If we truly want to do this at home, we got to be ready for understanding it's going to take 10, 15, 20 years to actually have the ability to do that all domestically.
Makes me wonder that idea of what, 2/5 of passenger cars, car sales to be EVs by 2030, makes me wonder how the heck do we do it, especially if we want everything to be made domestically.
This wasn't in the story, but I was recently having a conversation with a very big trading firm that actually trades all these metals, and they said it's just now getting on people's radar exactly how much copper you need. And what is in the story is Goldman's most recent research says we're not going to hit a deficit for 3 more years, so 2025. But by 2025, the price is going to more than double for copper, and that's because the market, the world is going to start. China is very much aware of that, and they are the ones also going out there trying to secure offtake agreements and buy part of mines in all different parts of the world that people like Elon Musk say, you know what, maybe we don't want to touch that copper mine in the Democratic Republic of Congo. Maybe we do just want the one that's in Arizona that we can trust, or the one that's in Chile that we can trust.
By the way, there was a proposed land swap. What happened there?
So the land swap was written into law in a bill passed in 2015 during the Obama administration. It was tucked into a defense bill, of course, so there's debates over did Obama actually like this thing. And then by the end of the Trump administration had enough push going from behind the scenes from lobbyists and whatnot. They said, let's approve the land swap, let's go. Biden gets in the first month, and the Forest Service, the USDA, which actually is in charge of all this, come and say, you know, actually, we're putting a halt on the land swap. And so that's where we are at right now. The land swap hasn't happened. The United States government says we still need to do more due diligence on this. And of course, Rio says the due diligence has been done. We've chosen all the various spots around Arizona to give them, to give the United States government. So let's get this thing moving on.
Are there other areas of the United States that have copper veins such as this? I know this is the biggest potential one, but I mean, what if Rio Tinto doesn't get access to this? What happens?
So where this mine is located is actually, like, for over 100 years been known as one of the great deposits of copper in the world. I asked one of the geologists there.
I would have never thought it was the U.S., but anyway, forgive me.
I mean, right there in Arizona, right? I mean, Arizona is like copper universe. I asked one of the geologists, why, like, what's interesting? He showed me this weird map with all this crud on it. I said, I don't get this, but I do notice this one spot here that makes no sense to me. The lines all converge. He goes, my job is to make money by getting copper out of the ground. What makes me love my job is the thing you just pointed out there about the geology. And he said, basically, we're still trying to figure out, after hundreds of years of looking in this area, what happened to the Earth millions of years ago for this to be the spot where copper is found.
Joe, it's in Jurassic Park. Just watch the movies. It's all there.
Which one,
kind of.
Daryl?
I don't know. I only like the first one. All right. Our thanks to Joe Doe, Metals and Ag, America's deputy team leader at Bloomberg News. This story in the new issue of Bloomberg Business Week magazine. It is out. Our thanks to the editor of the magazine, Joel Weber.
close. Bloomberg's comprehensive cross-platform coverage ahead of the U.S. market close starts right now.
This is Countdown to the Close. We have just 60 minutes left in your trading day, your trading week. Caroline Hine, Romaine Bostick, Katie Greifeld, and for Taylor Riggs. We are joined now by Carol Massa and Tim Stenovic. Of course, as we welcome across our audiences of TV, radio, and YouTube, a day where we see now 1% decline on the S&P and a full 5% on the week. Worst week since June, Carol.
Yeah, a really, really rough week. So once again, I'm looking for some outperformance in today's session. I found it in the home builders. The S&P 500 Super Composite Home Building Industry Index up about 2% in today's trade. This after we saw a definite movement after the University of Michigan survey showed lower than expected 1-year and 5-year inflation expectations. So if we think moving further out that inflation is going to come down, rates will come down, mortgage rates will come down, and maybe there's why you're seeing some optimism. But I will say home builders are still down for the week. They're down about 5% for the week, Tim, and down about 35% so far this year.
Okay, hard to find areas that are higher today, but I also managed to find a little bit of green. One area that is seeing some buying, Caroline, household products. This is the S&P 500 Household Products Index. It's up about 0.8%. We're talking companies like Procter & Gamble, Clorox, Kimberly-Clark, Colgate-Palmolive. They are all higher. I mean, even if there is a recession, if the economy weakens, you gotta have toilet paper, you gotta have toothpaste.
The necessities in this world. Meanwhile, you've got to have perhaps some strong stomach for the volatile nature of this market that you continue to suffer at the moment. Let's look at what's happening across your equity benchmarks at the moment, Tim, because we are off 0.8%. We've been down, and we've been down good, and volumes are significantly higher, up more than 40% on the S&P. We're currently off by 0.9%. We say that's 34 points lower. The Dow off by 0.6%. Again, you're kind of relative outperformer, but still on the week it's off by 4.25%. The real laggard of the week, down by 5.8%, is the Nasdaq, and it's off by 1.2% on the day. And on the day, the worst performer, Russell 2000, off by more than 2 percentage points.
I got to say that volume makes a lot more sense when you remember it's triple witching day. But before we get there, let's look at some of the sectors. You do see just a little sliver of green. That is consumer staples. A lot of that strength coming from Philip Morris, from Procter & Gamble. But you go beyond that, and it's just a sea of red. Right at the bottom, you have industrials and then energy stocks. This year's winners, not so much today.
Yeah, I mean, obviously a lot of the downdraft that we've seen, at least on this particular day, you can attribute that to the big pullback that we're seeing in FedEx, down more than 20% here on the day after that warning yesterday. That's really dragging down pretty much anything in the shipping and logistics space. XPO, JB Hunt, UPS shares down 4.8% on the day, and now setting up for what's going to be the worst weekly decline going back to early 2020. A lot of the retailers also moving lower, including Amazon, down about 2%. And we mentioned a little bit earlier here with a lot of the container board makers, big glut in that area right now. So a lot of concern here about what's being bought, what's being shipped, and how that reflects economic conditions. Two bright spots on your screen. Carol, you just mentioned it. The home builders higher here on the day. Lennar up about 3%. They actually report earnings next week. And NVIDIA, which has actually been oscillating between gains and losses, chip stocks getting a little bit of their mojo back on the back of a couple of upgrades. NVIDIA up 1% on the day.
And let's, of course, fold into the fact that amid all of this, the triple witching, the volatility that we see perhaps on a little bit of an uptick on the day, volatility in stocks remains really relatively weak in comparison to the ongoing volatility we've seen in the bond market, particularly the MOVE indexes, where we shine a light on for our radio audience, significantly elevated in terms of your blue line. We do see continued increase in volatility in bonds, and indeed in the FX market as we gear ourselves towards a Federal Reserve. Elevated FX volatility, actually pretty much languishing when you look at the VIX overall. And Carol, that's something you've been speaking about day in, day out.
Yeah, it is interesting, and I'm glad you brought it up again. I mean, this is the things that are facing investors, right? VIX down, we've got mixed economic news, we've got some big corporate companies coming out and some concerns about the outlook. So it makes you wonder what the administration has to say about the outlook. No surprise for them to kind of point out some of the optimistic points in our economy. Or David Weston caught up with Brian Deese. He's the director of the U.S. National Economic Council. They talked earlier on Bloomberg TV.
You look at where we are in the economy right now, you continue to see resilience. You see resilience at the consumer level. You certainly see that in the labor market as well. And, I would note that even in just the last couple of weeks, and I think, in no small part because of some of the legislation that we have passed, you've seen businesses announce forward investment in a variety of different sectors of the economy, whether from transportation, electric vehicles, semiconductors, or elsewhere.
And that, of course, is Brian Deese, director of the U.S. National Economic Council. So, he does make a good point, guys. It's one that we constantly bring out is the strength that we're seeing in the labor market. And it does make you wonder, how do you kind of square that with concerns about the economic outlook, Tim?
Yeah, I think what I'd add is that survey that we got from the Business Roundtable of CEOs earlier this week that showed that their own confidence had fallen to the lowest point in 2 years. And that affects things like, investment in CapEx, hiring, and to what extent they're actually going to be spending money. And that's why it's so important for us to think forward to when we start to get the next round of earnings and that commentary that we're going to get, but also if we're seeing downward revisions or indeed guidance being pulled from companies like FedEx.
Wasn't it Starbucks who came out, you guys, this week and talked about raising some of their CapEx? I mean, they're going to do like $2 or $3 billion, I think, over the next few years.
I only saw the NFT news.
Yeah, but I mean, a lot of that is basically to buy new ice machines because nobody's buying hot coffee anymore. So I think that's a little bit different and definitely specific to Starbucks. But I also think we're making a mistake too a lot. I think there's so much talk about sort of the blanket idea of whether we're in an economic downturn or not, and we sort of ignore the fact that there is some sort of stratification here right now in the economy where certain areas still are kind of firing on all cylinders, but other areas of the economy aren't. And I think this is going to, when we look back in history, 10 years from now, we're going to realize that this was a very unique recession if we are in one, or a very unique economic downturn if we are in one, that sort of matches up with the unique nature of the economic recovery we had coming out of the pandemic.
And, you always do a pop quiz, Romain, but the best performing stocks on the week this week, Royal Caribbean.
A lot of the travel stocks.
Yeah, travel stocks, because maybe some of that inflationary pressure is starting to wane there, at least when you're looking at flights, when you're looking at getting out, traveling, some of the experiences we've all missed.
Some of the experience we've missed. I took time off in October. I still have to book a flight for that. But to Romain's point, I don't know.
The time will not get taken off unless you buy those flights, Katie.
I know. I have to hurry. But to Romain's point that this could be a very unusual recession. Again, if we are in one, how many recessions have we had where the unemployment rate is below 4%? How many recessions have we had where the Fed is hiking? Whether this Fed continues to hike and is ultimately able to get to the terminal rates that people are batting about remains to be seen, but it definitely filters into those yield inversions.
Are we just increasingly coming out of the pandemic, right? And moving away from the pandemic spending to kind of getting out and maybe spending less on goods, but spending more on experiences and trying to figure it out. And you got to then layer on top of it what's going on geopolitically over in Europe, which is a whole other thing, especially when it comes to the global economy.
Yeah, well said. I mean, and I think as we sort of keep an eye on whether that's going to end up being systemic, particularly with regards to how Europe sort of weathers the winter, pun intended, with the energy crisis, and whether that does reverberate to the rest of the world.
The stickiness, right? That's going to be so important. All right, that's going to do it for now. We're going to be back in less than an hour's time. We're going to count you down to the close, wrapping up the Friday trade, wrapping up this week on radio, TV, and YouTube. Beyond the bell, we're going to count you down to today's market close.
You're listening to Bloomberg Business Week with Carol Masser and Bloomberg Quick Takes Tim Stenovic on Bloomberg Radio.
All right, you are listening and watching Bloomberg Business Week on this Friday. Carol Masser along with Tim Stenovic. And it's been a lot this week. And I mean, the equity trade really taking a big hit. But again, we see big swings overall. And those macro stories, whether it's supply chain, whether it's geopolitical, whether it's COVID still, it's out there. I mean, there are a lot of things that will continue to potentially create risks down the road.
Yeah, and perhaps one of the reasons we're seeing this sell-off continue, of course, is the risk that FedEx highlighted for us in pulling its guidance.
But is it company specific, or is it something more? Like I want to talk to UPS
Who was it yesterday
now?
Who told us that FedEx was seen by Alan Greenspan as a bellwether of the economy?
Well, it is a bellwether, right? So is UPS, right? Because they are the guys that are responsible for moving things around. So it's a really important company. But you do also, I mean, we're going to get into this with our Lee Klaskow, because he had some research out that said maybe it's much more company specific. FedEx is different from UPS in terms of their business models. But I do wonder, I feel we see this in retail. Sometimes it's a company specific thing, and not all companies that come out have bad news.
That's true, but what happens if the contractors that FedEx uses aren't working as much, and what happens if their planes aren't flying as much?
Right. So the FedEx supply chain, it's not good.
Exactly.
But look at Apple. We just talked about Apple and consumers paying up for a more expensive iPhone.
Still seeing Apple down 1.5% today, though.
Yeah, because it's just a down day. I don't know. More to come on this, that's for sure. All right, let's get to world and national news right now on this Friday. Here is Nancy Lyons. She is in D.C. Hey, Nance.
Thanks, Carol. King Charles III and his 3 siblings have just wrapped up standing vigil around their mother's coffin as it lies in state at Westminster Hall in London. Charles, Princess Anne, Prince Andrew, and Prince Edward all stood with their backs to the flag-draped coffin of Queen Elizabeth II, their heads bowed. The Queen's funeral is Monday. Russia has still not responded to a U.S. offer for a prisoner exchange involving Americans Brittany Griner and Paul Whelan. National Security Council spokesman John Kirby was asked today where things stand.
I think that's a better question put to our Russian colleagues. We made a serious offer. We want them to accept it.
Kirby's comments came ahead of private meetings this afternoon between President Biden with Griner's wife and Whelan's sister. To combat corporate crime, the Justice Department has announced a plan to encourage companies to detect and preemptively report possible violations of the law to prosecutors.
Deputy Attorney General Lisa Monaco explained the initiative in a Bloomberg interview.
We want companies to have in place a program that allows them to detect misconduct and detect it early, to be able to take steps to correct it. And that's going to be real and predictable benefit to companies who step up and own up.
For companies that don't, Monaco said, prosecutors would come down especially hard if it's they who uncover the malfeasance. In Washington, Irv Chapman, Bloomberg Radio.
The White House is offering state and local governments $1 billion over 4 years to fight cybercrime. Global news 24 hours a day, on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Nancy Lyons.
All right, Nance, thank you so much. Nancy Lyons in our 99.1 newsroom in Washington, D.C. So this story by our Sri Natarajan, it is a Bloomberg exclusive, and it talks about Goldman and their Marcus Consumer Unit, which we've talked about a lot. Sri's really been all over this.
Yeah, remember, I mean, they wanted to create this banking arm for retail-facing, consumer-facing banking arm. They brought Marcus in. They built
6
Marcus.
years, right? They've been working on this.
Yeah, and then they also had Clarity Money, that acquisition.
Right.
That was a big one as well. Like you said, 6 years in, but it's now the focus of a new review at the Federal Reserve.
Yeah, what Fed officials have been looking into is apparently Goldman's online banking platform aimed at retail customers, according to people with knowledge of the matter. For at least several weeks, they've been peppering Goldman management with questions and follow-ups in a process that's still continuing, according to those in the know. And this review, why this is interesting is it goes beyond the central bank's regular oversight of the firm and is distinct from its more frequent industry-wide looks at business lines of interest. I mean, we know that Fed officials are constantly looking at the health of the monetary system, the banking system in particular. That's normal business. This is something a little bit different.
Yeah, Sri Natarajan and Hannah Levitt, right, that by zeroing in on Marcus, the central bank is taking stock of a division that's relatively new and growing substantially inside a company without much history dealing with the general public. It's not indicative of any wrongdoing, but it is another headache as CEO David Solomon marches ahead with his ambition to expand Goldman, of course, a merchant of high finance, in the world of consumers, soaking up deposits, issuing credit cards, and at some point, offering checking accounts to the masses.
Yeah, and you got to be, if you're an investor and you're kind of looking at this, I mean, this examination definitely putting some more pressure on Goldman's leaders to showcase their command of the business and tighten controls. I mean, the one thing you never want, especially if you're a financial firm, but any firm overall, you want to make sure that nothing seems to be amiss. And again, as Sri reports, nothing seems to be, and this oversight that the Fed is doing doesn't necessarily mean it will lead to something, but nonetheless, you don't even want stories like this potentially out there.
Yeah, check out this story. It's on the Bloomberg terminal. As you mentioned, Carol, it's a Bloomberg exclusive. You're listening to Bloomberg Radio.
markets, headlines, and breaking news 24 hours a day at Bloomberg.com, the Bloomberg Business app, and at Bloomberg Quick Take. This is a Bloomberg Business Flash.
From Bloomberg World Headquarters, I'm Charlie Pellet. FedEx delivers losses for U.S. investors. The Dow, the S&P, Nasdaq all on the minus side, with the S&P well below 3,900. Let's head right over to the first word breaking news desk for today's afternoon call. Here he is, Bill Maloney.
And good afternoon, Charlie. U.S. stocks under pressure, but well off this session lows. Dow's down 200 points, was down 412. S&P's dropped 37, and Nasdaq is lower by 133. The U.S. 10-year yield at 3.45%. Gold is up 11. Oil is in the green. And you mentioned FedEx. Transports plunged 5.6% after FedEx withdrew its forecast on worsening business conditions. Of the main 11 SB sectors, only consumer staples are trading higher. Industrials and energy led to the downside, and leaders to the upside in the Dow, Home Depot, and Intel, while Boeing, Disney, and American Express were under pressure. In other news, Kohl's was cut to junk by S&P, and wrapping things up, FedEx fell 21% today, in the biggest drop since at least 1980. Live from the first breaking news desk, I'm Bill Maloney. Charlie.
Okay, we thank you very much, Bill, and to hear live breaking news over your Bloomberg type squawk. SQUAWK on your terminal. I'm Charlie Pelleton. That is a Bloomberg Business Flash.
All right, gotcha, Charlie. Thank you so much. Well, talk about Houston. There's a problem. FedEx shares, as you know, we've been talking about how they have tumbled today, down the most in over 40 years after pulling its earnings forecast on worsening business conditions, a potentially worrying sign for the global economy. And I think about this kind of story 24 hours ago, Tim, essentially, we just started to break down this. And I wondered about analysis, especially when it comes to our Bloomberg intelligence team. How they're seeing it now.
Yeah, really eager to speak to Lee Glasgow, Senior Transport, Logistics, and Shipping Analyst for Bloomberg Intelligence. Lee joins us this afternoon via Zoom from Bloomberg Intelligence headquarters in Princeton, New Jersey. Lee, good to have you with us. We were really itching to get you on to talk all about this afternoon. The question that Carol asked sort of rhetorically earlier was about whether this is a company-specific story, if it's FedEx specifically, because we're seeing it weigh on certainly other sectors and peers within the sector. But take us into what exactly the concern is that FedEx has.
Yeah, so what I would say is it company specific? Yes. And is there a read through for the rest of the broader economy? A little. And why we say that is that, you know, in the release, the company mentioned the fact that there are some service challenges in Europe, and we view that as mostly dealing with the TNT integration, coupled with the fact that, you know, Europe is, I'm sure you're all aware that Europe's having some problems with inflation due to high energy costs, and that's having a major impact in demand. You know, the risk of Europe going into a recession, or if they're not in a recession already, is a lot higher than here in the U.S. And, you know, that is probably driving some of the weakness that we saw in Express. Express revenues came in 5% below expectations for the first quarter when they pre-announced yesterday. And then the margins that, you know, that they showed, the adjusted operating margins were about 1.7%, which is very low relative to history. I mean, historically, it's been around about 5 to 6%, and so you've seen a real step down in margins, and it probably has to do with higher costs. With the inflationary aspects that we were talking, lower demand, and some integration problems at TNT. And for some background, you know, TNT was an acquisition they made in 2016, and they did it so they could be more competitive in Europe with UPS and Deutsche Post. You know, they're still third when it comes to Europe, but they're a lot closer to the number 2 UPS in Europe now. But the problem was in 2017 there was a huge cyber attack on TNT, which rendered it pretty much useless. And if it wasn't for FedEx's capital, the company probably wouldn't be around today. And then that, coupled with a couple of management missteps, we'll call them, really slowed the progress of integrating TNT. And then, you know, we had a pandemic, and that threw a wrench in everyone's business model. And so we just think that the benefits, if any, are really going to be kicked down the road as management tries to properly resource its network in the U.S. and in Europe.
Hey, Lee, what does this mean for the company's new CEO who took over just in June? Inherited this and just trying to make it right, or is this maybe a first big stumble?
Yeah, so Raj Subramanian, he's became the CEO and president in June. Also Richard Smith became the CEO of Express in April. So they're relatively new, shall we say, to their role, but they've been longtime managers in the organization. What I would say that's very different than what we're seeing at FedEx versus UPS. In 2020, UPS got a new CEO, Carol Tomei, and she was on the board. But people were a little skeptical about her because most of UPS senior managers were always used to be able to say that, my first job was when I was in college loading and unloading UPS trucks, and I've been there forever. And so she was like not quite an outsider, but kind of an outsider. And she's really done a phenomenal job. She's been selling off unprofitable businesses. She sold their less than truckload business off to TFI. They're really focused on what they're calling a better, not bigger strategy, which really seems to be paying off. And UPS had a sell-side event on September 9th, and they didn't call out any glaring issues. They actually reiterated their 2022 guidance, and that's why we think it's mostly a company-specific issue for FedEx versus the broader economy. We'd be naive to think, yes, growth has slowed over the last 3 months, but also, FedEx has more of exposure in China, and the zero tolerance policy of the Chinese government due to COVID have really restricted economic activity there, and that's gone on longer than I think most of us would have wanted or thought, and that's also something weighing on FedEx's business as well.
Just want to throw out some numbers looking at the DES page on the Bloomberg. When you look at FedEx, U.S. 2022 rev, almost 65 billion. International was almost 29. If you pull up UPS, U.S. is about 74 billion. International is about 23. So that speaks really to your point. So, I mean, when we think about UPS, Lee, that's more of a U.S. play, domestic play?
Yeah, and when I was also in UPS is one integrated network. So they have, an express and domestic business. But, when someone delivers a package to your house, it's not a separate organization. At FedEx, the majority of their packages are either on their ground network, which are independent contractors, or their express network, which are employees. A lot of people on the street are kind of wondering, what the rationale for that is, and does it truly make sense to not have an integrated network?
Well, great to check in with you. Lee Klaskow of our Bloomberg Intelligence team. We really appreciate it. Do want to mention, too, a headline that crossed the Bloomberg terminal. Credit Suisse considering reviving the first Boston brand name as the Swiss lender seeks ways to boost the fortunes of its beleaguered investment bank. This is according to people familiar with the matter. I mean, this is a name that was retired 17 years ago. I remember booking people and talking to people from First Boston. So interesting. What's old is often new again.
Back to the future, Carol.
Exactly. You're listening and watching Bloomberg Radio.
Broadcasting live from the Bloomberg Interactive Broker Studio in New York. Bloomberg 1130 to Washington, D.C. Bloomberg 99.1 to Boston. Bloomberg 106.1 to San Francisco. Bloomberg 960 to the country. Sirius XM Channel 119. And around the globe, the Bloomberg Business app and BloombergRadio.com. This is Bloomberg Business Week.
All right, it is Bloomberg Business Week. It is Friday. Thank God. Weekend just around the corner.
Yeah, we got an hour and a half to go, Carol.
Okay, so am I jumping the gun?
You're jumping the gun a little bit.
You know,
Markets
my
are still
world's
open.
turned upside down. Maybe it's the inverted yield curve. That's
All right,
why.
that's a good tease to Ira Jersey, who we have coming up in just a few minutes. Let's get more on the markets, though. Charlie Pellet, less than a half hour to go.
Indeed, let's begin with the 2-year, 3.85%. Ira's going to have a whole lot more on that coming up in just a moment. 10-year yield right now, 3.44%. Stocks lower, but perhaps the key takeaway as we head toward the closing bell here, we are off session lows. No qualifier, but off the lows with the S&P now down by 38 points, a drop there of 1%. The Dow Jones Industrial Average down 210 right now, drop there of 0.7%. Nasdaq slumping 143, a drop there of 1.2%. Today's catalyst, FedEx, after last night's warning, FedEx plunging now by 21.6%, rivaled UPS down by 4.8%. So the Dow, the S&P, Nasdaq are all declining. Among the day's economic reports, a survey from the University of Michigan, which showed U.S. long-term inflation expectations fell to the lowest in more than a year in early September. Joanna Shu is director of the University of Michigan's Surveys of Consumers.
Consumers are still telling us that high inflation, high prices are really eroding their living standards. So it's really going to take some sustained improvements in inflation for that number to come down materially.
And again, the S&P down 38 points, drop now of 1%, 2-year 3.85%, 10-year 3.44%. Spot gold up 0.6, $17.74 the ounce. West Texas Intermediate crude up 0.2%, $85.27 a barrel. As we have been reporting, we've got the latest iPhone hitting stores. Apple counting on well-heeled shoppers to make the device a hit during a year of roaring inflation and shaky tech spending. Apple shares today, they are trading right now little change, but we do have Apple down by just about 1%. As we've been reporting as well, sources tell Bloomberg Credit Suisse Group is considering reviving the first Boston brand name as the Swiss lender seeks ways to boost the fortunes of its beleaguered investment bank. Executives recently floated the idea internally of bringing back the storied first Boston brand, which had retired about 17 years ago. And that's a Bloomberg Business Flash.
All right, Charlie Pellet, thank you so much. Well, an important market story, no doubt about it, is the U.S. yield curve. Today, we saw the yield on the 2-year U.S. Treasury now climbing for a 7th straight trading session above its highest levels in almost 15 years on investors really agita over next week's expected interest rate increase by the Federal Reserve. We continue to really see this trade.
Hey, we've got a great voice on this. We've got Ira Jersey. He's chief U.S. interest rate strategist at Bloomberg Intelligence, joining us this afternoon on the phone from New Jersey. Ira, good to have you with us this afternoon. In your most recent research, you write that the Treasury curve inversion is stickier as the inflation glide path slows. What's the inversion telling us right now about the economy?
Yeah, we're saying here that, look, in the longer term, the economy is going to weaken. We'll probably have lower inflation, and we'll ultimately wind up seeing interest rates lower and the Fed having to ease. But it's also telling you that the Federal Reserve is going to increase interest rates, and one of the reasons that 2-year yields have been going up faster than 10-year yields is just the idea that we've now priced in another 50 basis points of interest rate hikes from the Fed over the next 6 months. So you had to reprice the entire yield curve in order to get there. And we're saying now that, like, hey, the Fed is serious about fighting inflation, and the market's finally kind of getting a clue here, I think.
You've been really great in kind of pointing this out and kind of where things are heading for us here at Bloomberg. And I do wonder, Ira, then, so when we talk about, we go back and forth about recession, are we in a recession, are we not in a recession? As the inversion becomes stickier, as you write about, should we be like, yeah, we're going to be in a recession if we're not already?
Yeah, well, it's a matter of when we're going to be in a recession, not necessarily if. And there's a lot of signs that the economic slowdown we're seeing now looks a little bit, to me anyway, like a mid-cycle slowdown, where typically what happens in the business cycle is you get big recoveries coming out of recessions, where you have very strong growth, you have very strong both nominal and real growth, and then kind of you get some of the froth out of the market and out of the economy, and you have this bit of a mid-cycle slowdown, and then you rebound a little bit after that. And if that's the case, then the worry for me, or not the worry, but the way that I think that the world will play out in that scenario is that the Federal Reserve might actually have to hike interest rates even further than what the market's pricing, or, and I think this is the much more likely outcome, is they get to 4.5% and then keep it at 4.5% for say a year.
Speaking of stickiness, right?
Yeah, and that's part of the stickiness, right? And it's the idea that you'll wind up hearing a lot of Fed officials talk about long and variable legs monetary policy, and we want to wait, to see what the 4.25% of interest rate hikes that we did in a year, how that's going to wind up affecting the economy, and that also gives them optionality, because if inflation then does turn around and goes back up, then the Fed can start to hike again if it needs to, right? So I think that's kind of the path that I see the Fed ultimately taking.
Yeah, Ira, it's really interesting that you say this, because in our week ahead from Bloomberg Economics, Anna Wong writes that equally intriguing when it comes to next week's Fed meeting is less about, 100 versus 75 basis points, but it's what the Fed will signal about how long it plans to keep rates high, right? Because the totality of the data since that last meeting, more broadly based price increases, short-term inflation expectations passing through, points to inflation being a problem that will stick around for a while. So take us through how that affects economic growth.
Yeah, so I'd say two things. I'd say one, I was actually yesterday when I was writing my Fed preview, which will be out on Monday, I wrote something very similar to what Adam wrote. So it's a great.
That was a deep tease. Great minds think alike. I like that.
So I do think that if the Fed keeps interest rates at 4.5%, I actually think that could be good for the economy, kind of in the medium term, primarily because it allows businesses and households to get used to these, quote unquote, more normal interest rates, and it lets people grow into them. Now the risk, of course, and this is something that Anna brought up, which I think very correctly in her piece today, was the risk is that the Federal Reserve starts to ease a little bit too quickly, and that was what happened during the Burns Federal Reserve back in the 70s. A lot of people, a lot of academics, and myself included, think that the issue was he didn't leave interest rates at the higher level enough to be able to get the froth out of the economy, and instead started to ease too quickly. So I think that when we talk about the Fed at this point, we're talking about where is the Fed put, right? People are like, oh, if the stock market goes down by Ray Diallo's 20%, is the Fed going to start to cut interest rates? Maybe, but I think more importantly is, does the real economy start to slow down enough that the Federal Reserve panics, right? They're not going to worry as much about the equity market and revaluing, multiples and the like that might occur, but more importantly is the household sector, right? So right now they're focused only on one side of their mandate, but eventually they'll have to bring back their full employment mandate, and that's really when they'll start to panic and they'll start to cut. And when they cut, they'll probably be a little bit behind the curve in cutting, and will cut very quickly.
They've definitely had some room and luxury because of the strong labor market. Ira Jersey, thank you so much. Chief U.S. Interest Rate Strategist at Bloomberg Intelligence on the phone in New Jersey.
Let's get to the national news with Nancy Lyons in D.C. Hey, Nance.
Thanks, Tim. More emotional imagery coming out of London, where King Charles III and his three siblings have finished holding vigil around their mother's coffin. All of them wore military uniforms and stood with their backs to the coffin of Queen Elizabeth II, with their heads bowed and their eyes closed. Well, so many people have lined up to say goodbye to the Queen that authorities had to call a 6-hour pause for people joining the line. Cyrus Moore got in line before that cut off.
The people are dedicated. That's why they're at. That's the mood, dedication.
The line is now moving again, but the wait is said to be more than 24 hours. Soccer star David Beckham told CNN he had to wait more than 12 hours. President and First Lady Jill Biden head to Great Britain tomorrow for the Queen's funeral, which will be held Monday in London's historic Westminster Abbey. A special master is in place at Mar-a-Lago. U.S. District Judge Aileen Cannon has named veteran Judge Raymond Dearie to look through all 11,000 documents that were seized from former President Trump's Florida home. At the same time, the judge has denied the Justice Department's request to use about 100 documents marked classified in its criminal investigation. We get more from Bloomberg Government's Emily Wilkins.
The Justice Department is asking that certain documents not be included in the special master review because of the national security risk they pose and how they could impede their pending investigation on it. We'll have to keep an eye on the courts as far as what's going to be happening there.
Bloomberg Government's Emily Wilkins reports Judge Cannon is giving Dearie until November 30th to finish his review. Global news 24 hours a day, on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries.
All right, Nance, thank you so much. Carol Master along with Tim Stanovic here live in our Bloomberg Interactive Brokers studio, streaming on YouTube. It is Friday, and was it 24 hours ago or even?
It was on Wednesday.
Wednesday that you're like, whoa, check this out.
Yeah, big story, of course, was that Patagonia's founder, Yvon Chouinard, he announced that he would be transferring ownership of the company to two different separate entities. One would be a trust and one would be a nonprofit. It's something that is a really big deal. The valuation of the company is $3 billion. And it's really seen as a way to make sure that the company still lives its mission beyond, when he dies.
It's so interesting because it's against this bigger, broader backdrop, right, of a lot of very wealthy individuals, mostly billionaires, who've made these pledges to basically give away all of their wealth.
But most of those pledges have been after they die.
Correct. And he's being much more proactive. And he has been from the get-go. He's kind of not your typical wealthy, successful individual. I mean, it's great to read about him. He doesn't care about being known.
He's got no phone. He's got no computer. He likes to go fly fishing in Wyoming. That's like his thing.
Kind of the same stuff over and over again. But this deal that is structured in ways that also bring him some perks by letting him and his family, as you said, keep control of Patagonia while also shielding them from tax bills that could have totaled hundreds of millions of dollars. You could say that he did this so that the money does still go for the causes.
Yeah, check out this story. It's on the Bloomberg Terminal. It's by Devin Pendleton and Ben Steverman on the wealth team. It's interesting because we're seeing increasingly wealthy, really ultra-wealthy people do this. They write that Chouinard is at the fore of a small but growing movement among the ultra-wealthy to use nonprofits to exert political influence long past their lifetimes. Like I said, a way for the company to continue to live its mission long after he's passed.
Right, and actually make sure that most of that money actually can be put to work, right?
Yeah.
By using nonprofits.
Exactly. He said he didn't want to sell the company because you can't guarantee that the company would continue to live its mission. And yeah, he said it would be a disaster to take the company public.
It's a great read, and as we continue to track this story, so go to Bloomberg.com if you want to read it in its entirety. This is Bloomberg.
markets, headlines, and breaking news 24 hours a day at Bloomberg.com, the Bloomberg Business app, and at Bloomberg Quick Take. This is a Bloomberg Business Flash.
From Bloomberg World Headquarters, I'm Charlie Pellet. 13 minutes to go ahead of the closing bell. We've got the Dow, the S&P, Nasdaq 100 index, all in the red. Perhaps the key takeaway, we are off session lows, but even so, S&P 500 index on track for a roughly 5% drop this week. Right now, we've got the S&P down 34. That is a drop of 0.9%. The Dow lower by 170, a drop there of 0.5. Nasdaq is down 138, a decline of 1.2%. Stocks trim losses as dip buyers surfaced in the last hour of trading after stocks fell to session lows amid growing concern over outsized Federal Reserve interest rate hikes. The 2-year yield 3.85%, the 10-year yield 3.44%. Spot gold up $8 the ounce to $16.74, up 0.5%. West Texas Intermediate crude up 0.2%, 85.28 a barrel. FedEx, after last night's warning, now plunging 21.5%. Rival UPS lower as well, down now by 4.9%. I'm Charlie Pellet. That is a Bloomberg Business Flash.
Hey, thanks so much for that update, Charlie Pellet. Really do appreciate it. It is 3:48 on Wall Street.
The following is an editorial from Bloomberg Opinion.
This editorial was written by the Bloomberg Editorial Board. Since Russia launched its invasion of Ukraine in February, China has consistently refused to criticize President Vladimir Putin. Instead, it has amplified Russian misinformation and bought huge quantities of Russian oil and gas on the cheap. The West should ensure Chinese President Xi Jinping understands the price of allying too closely with Putin. If the U.S. and Chinese leaders meet as expected at the G20 summit in November, Biden should stress that growing Chinese investments in Russia could spur new penalties. The U.S. should also strengthen ties with countries threatened by a Sino-Russian alliance, including India and Vietnam. Such moves won't end China and Russia's partnership, but with commitment, patience, and unity of purpose, the U.S. and its allies can limit both countries' ability to threaten the global order. This editorial was written by the Bloomberg Editorial Board. For more Bloomberg Opinion, please go to Bloomberg.com/opinion or OPIN Go on the Bloomberg terminal.
This has been Bloomberg Opinion.
I'm driving in my car. I turn on the radio.
How about you let me drive?
Oh, no. Who's gonna drive you home? Honey, please, I'll do the driving. Drive on. Excuse me, I want to drive. It's the question that drives us.
This is the Drive to the Close.
That funky music will drive us till the dawn.
On Bloomberg Radio.
TikTok, everybody. 10 minutes left in today's, well, actually 9.5. Let's be exact here. We like numbers and like being exact on Bloomberg. So about 9.5 minutes left in today's trading session. Getting ready to wrap up what has been a week, certainly for the equity trade, a bearish one. We're seeing significant losses. Losses in today's trade, although we are off, Tim, our worst levels of the day today.
We are really interested to hear what Brian Railing has to say. He's head of global fixed income strategy at Wells Fargo's Investment Institute. He joins us on the phone from St. Louis this afternoon. Brian, how are you?
Great. Thanks for having me.
Okay, let's talk fixed income here. Just give us an overview of where you think we are right now and what the fixed income market is telling us about the economy. Because if you look at the equity market, you're pretty much seeing alarm bells across the board.
Yeah, well, the fixed income market's been giving alarm bells here since June with the yield curve inverted. And, that inversion maintains itself. If you look at just 2s to 10s, almost 40 basis points inverted there. So, it's saying that rough times ahead for the economy.
So where's the value and where's the difficulty in figuring out, especially when it comes to the fixed income market, when you're looking at price and yield right now, where's the value? Where's the right trade?
Yeah, well, the easy trade is just short term because you can get really nice yields there with very little risk. Now, I'm not sure. I don't believe we put in the peak yet in those longer term rates, but I don't think we're too far away from that. So I do think there's going to come a time when really extending duration and buying long term bonds will pay off in the long run.
The sentiment numbers today, we're talking about, 1 and I think, was it 10-year inflation expectations and coming down. So do you anticipate that we will see a significant turnaround when it comes to the rate outlook? Maybe it's next year, maybe it's late next year, maybe it's early in the following year. It's about the 1 year and 5 year, inflation expectations as a result of the University of Michigan surveys showed lower than expectations. So what's your expectation when it comes to rates?
Yeah, I do. I do believe that we're entering a point. Again, I don't think we've hit the peak yet, but we're entering a point where it's a really good buying opportunity for longer term duration. Simply for that reason, I do expect that inflation expectations and eventually inflation over the intermediate to long term will go down. I believe that the Fed will win its war and will hit its targets. Now, not over the near term. There's going to be a lot more, I think, fear around inflation, a lot more work the Fed's going to have to do, but I think the Fed will do the work that's required.
Brian, what's near term, though, in your view? I mean, I think what's so crucial, and to be fair, I think no one anticipated the inflationary pressures in terms of the timeline and that they would be so sticky for so long. But do you have a timeline when you think inflation starts to come down significantly?
Well, significantly, I think we're going to probably have to wait until, at least the first quarter of next year, if not a little bit beyond that. Okay. But, significantly still is not down to the Fed's targets. That's what the markets really have to appreciate. And, just because we get inflation maybe down to 5% or 4%, yeah, that's a big move down. But I don't look for the Fed to blink. I think the Fed will continue to hold those rates at high level until they're confident they're going to win.
Hey, Brian, what about when it comes to quality of fixed income? What are you telling clients right now? What should they be focused on?
Yeah, we're up in quality, but the yields are looking more attractive by the day in a lower quality. That said, buying low quality, buying below investment grade fixed income going into a recession is not a good strategy. We're likely to see more fear in the market, see those spreads widen out. Again, I think there's going to be great buying opportunities, and maybe spreads won't widen out to the 700-800 we've seen in past recessions, but I'd hold off here until it's a little bit more certain exactly that we've entered into a recession and we maybe get some spread widening.
So what would be the sign that's happened? I mean, do you need the NBER to come out and say that we're in a recession?
No. I would just like to see the spreads, widen out to 600-700 in those below investment grade indices. To me, that would be the bond market saying, listen, we've already got the fear with the yield curve. If we get some fear in credit spreads, it starts to line up. You do not want to wait for a recession to be called or to be obvious we're in a recession, but waiting for those indicators, the cheapening prices, it's almost certainly going to happen into a recession.
All right. How do you pit the U.S. versus maybe overseas? Where are the opportunities, essentially? How do you play it?
Yeah, I mean, we're still U.S.-centric for sure. I think overseas has a lot more issues, and their economies are not in as good a shape as ours is, even if ours is weakening. And we've got energy crises looming potentially this winter, especially over in Europe. And so, to me, I would definitely stay U.S.-centric.
I know this depends on, a person's risk tolerance and where they are in their lifetimes, but how do you look at the role of fixed income in 2022 in a portfolio, given that rates have been so low for so long?
Yeah, well, I mean, 2022 has been a rough year for all asset classes, including fixed income. But number one, fixed income, you do see less volatility. So again, as you are an investor looking maybe less on the return side and more on the, your stability, you're going to continue to add more and more fixed income. But now things are getting very interesting with these higher yields, with even very low risk in short term, being able to get yields that we have not seen in some time. And if you are specifically in a high tax bracket, muni bonds look particularly attractive too. Again, the high quality, shorter term, it's kind of a no-brainer.
Hey, do you have a quick thought on mortgage rates and what happens? We certainly saw home builders a little bit of a rally in today's overall downward equity trade, and that was because of some of the optimism about longer-term inflationary expectations, as we talked about. Some thoughts on mortgage rates, just quickly.
Again, they're going to remain elevated. That market is going to remain difficult. It's going to be difficult for people to afford the affordability. But again, kind of with my intermediate to longer term outlook, I do expect inflation expectations and eventually inflation to move lower, and that should cause those longer term rates to start to tick a little bit lower, and that will really bring down mortgage rates.
All right, we got to run. Hey, have a great weekend. Yep. Brian Railing, he is head of global fixed income strategy at Wells Fargo Investment Institute, joining us on the phone from St. Louis on this Friday. Just a couple of minutes left in today's trading session. We are up near our best levels of the session, still down across the board, but certainly a lot more optimistic than what we saw earlier in this session. We are getting ready, though, to join our TV colleagues, count you down, wrap up that Friday trading day on radio, TV, and YouTube.
Beyond the Bell, Bloomberg's comprehensive cross-platform coverage of the U.S. market close starts right now.
And right now, we are 2 minutes away from the end of the trading day. Romaine Bostic, Caroline Hyde, Katie Greifeld in for Taylor Riggs. We're counting you down to the closing bell. Here to help take us beyond the bell on this Friday afternoon, it's our global simulcast with Carol Masser and Tim Stenovic. We welcome our audiences across Bloomberg Television, radio, and YouTube. Taking a look, Carol, right now at the S&P 500, 3877, which is actually right around the highs of the day. The bad news is we're still down 0.6%.
Yeah, but I wonder if we do think about it a little bit optimistically again in terms of seeing some buying into the close. But I've got to say, I'm taking that 5-day average and just looking at the steep losses, Tim, that we've seen in the markets overall for the week, down about 5.5% on the Nasdaq, down about 4.7% on the S&P 500.
Okay, since Taylor's not here, I'm going to do a little fixed income because we just spoke to Brian Railing, head of global fixed income strategy at the Wells Fargo Investment Institute. He said, look at what the bond market has been telling us since June, right? Rough times ahead for the economy. That doesn't necessarily mean he doesn't think there are opportunities. He says there's really good buying opportunities for longer term duration because he does expect inflation expectations and inflation over the intermediate to long term to actually come down, but not over the near term, kind of matching a little bit of what we saw with those UMISH numbers earlier today.
Also, if you're just looking to clip coupons, I mean, you look at the front end where yields are the highest they've been in a very long time. There's actually some decent return there.
Overall, the only decent return seems to be if you're long dollar in whatever ETF you might have found to track that. But this is the only area of strength. Today, a little bit of weakness, but overall, on the course of the week, it has marched steadily higher. This is all about anticipation of the Fed.
Yeah, anticipation of the Fed. And I think that will make actually Monday and Tuesday kind of interesting to see if maybe we see a lot less volume. Maybe people sit on the sidelines in anticipation of that midday announcement, 2 p.m. time out of Washington, and of course followed by that press conference. Still a ways away. Until then, we got a weekend ahead of us and a closing bell here in New York on this Friday afternoon. The Dow Jones Industrial Average going to finish the day down by about 140 points, or 4.5%, or excuse me, 0.4%. The S&P 500 lower by about 0.7%, and the Nasdaq Composite going to close down by 0.9%. The Russell 2000 really got hit hard today. We should take a quick look at that, with it finishing down 1.5%. And real quickly, we must mention the Dow Transports, that average closing lower by 5% on the day.
Yeah, no doubt about it. FedEx hurting that index as a result. Just quick check on the S&P 500. We're going to drill deeper into the trade today, but the S&P 500, most names, Katie, in the index lower today, 362 to be exact, 138 actually holding on to some gains and 3 unchanged.
And let's get specific and look at some of the industry groups. For our radio audience, there's not much green to go on. You do have 5 managing to finish in the green. Up top is the semis, the chips, getting a little bit of love today. That industry group up about 0.5%. Then you look at the bottom. You have your pick, but if you look all the way at the bottom, you have the transportation index down almost 5%. But Carol, a lot of that, of course, is from FedEx.
Yeah, no doubt about that. So let's get to some of the gainers. My fingers crossed that they're holding on to their gains. Netflix, yeah, pretty much closing just off its highs of the session, still up about 2% here at the close. Top in the Nasdaq 100, top in the S&P 500. Remember, we got the Evercore ISI upgrade yesterday. Well, Citi today maintaining its buy rating, but upping the price target to 305 from 275. Stock closing at 240 and change. This stock, though, still off about 60% so far here in 2022. Bolero, B-O-W-L, Bowl, appropriately, is the ticker. This stock up about 7.5% in today's session, rising as much as 10% at its highs. The owner and operator of bowling centers posted fourth quarter revenue that topped expectations, hitting, and I believe maybe closing at an all-time high as well. It's about a $2.2 billion market cap, up about 50% Rumate, you know this one?
Yeah, well, it is all-time high, and I just want to say those numbers were phenomenal. I mean, the beat differential here, I can't do the quick math, but it was like 40% higher than what the street was looking for on the revenue side.
Yeah, huge. Maybe this is part of the experiential play that people
Maybe
are out there.
we should all go bowling together.
Right? You don't need to buy
Yeah,
bowling.
we've never had an outing anywhere together.
Well,
Carol doesn't like to hang with us outside of work.
I hung with you last night out of work.
Oh, that is right.
He just has a short.
I have a short-term memory.
Help me here. All right, one more for you. Newmont Mining up about 3% here at the close today. Top in the S&P 500. Barron's was out with a story saying the stock is too cheap to ignore, why it's time to buy. And they talked about production increases, dividend yield, and that the dollar won't rise forever. And we know gold is priced in dollars. So as the dollar rises, gold is worth fewer dollars. So that's why maybe this could be an interesting play going down the road.
All right, well, we got some interesting decliners today. We got to talk about FedEx. Shares closing down 21%, the biggest drop since at least 1980. This is potentially worrying sign for the U.S. global economy as the company withdrew its earnings forecast on worsening business conditions. I got to tell you, though, we spoke to Lee Glasgow at Bloomberg Intelligence a little earlier. He covers logistics, and he argues that FedEx's woes, they maybe more are company-specific rather than industry-specific, as, after all, look what we saw from UPS just last week on September 9th. They had this sell-side event, and they reiterated their 2022 targets. So perhaps an overreaction. We'll have to wait and see. NCR Corporation, they produce ATMs, self-checkout, scanners, payment systems, and more. Finishing the day down by more than 20%. It fell as much as 26% earlier. This after the company decided to split itself into two separate entities. It was a blow to merger investors who were betting on a sale of the entire company. And then International Paper falling 11.2% today. Packaging Corp of America also falling. They were both downgraded to underperform at Jefferies due to a, quote, massive inventory glut when it comes to container board, a potentially worrying sign for the U.S. economy as well.
And before we get to Caroline, I just want to point out, too, I mean, we had something like 130 sort of 52-week lows across the tape today, and some pretty notable names on that, too, Tim. A couple that you didn't mention, including Adobe, which was actually the worst performer that we saw this week, but a lot of big names in there, and our previous guest here on Bloomberg Television, Eddie Elfenbein, sort of highlighted that, including Alphabet hitting 52-week lows, Meta, which of course we know has its own problem, but you throw Whirlpool, Tyson, 3M, a lot of these companies in there, a lot of big names now at the lowest that we've seen in a year.
You know, our Anurag Rana just putting out a note about Adobe and saying that Adobe should walk away from the Figma deal and instead accelerate repurchases. So we'll see whether or not we get any kind of changes, but investors certainly weighed in on that one, guys.
But the fact that you're seeing such a breadth of companies exposed to the housing market, companies exposed to technology, companies exposed to packaging, all at those 52-week lows, just shows the breadth of the worry in the economy at the moment, the worry that we're going to see lower growth. But also globally speaking, it's interesting that we see oil having a third week of declines on overall. On the day, we see natural gas plummeting 6% here in the US, of course, seeing big moves over in Europe as maybe some of the anxiety about natural gas, about the supply coming from Russia into Europe, eases a little bit, but really we keep it close on 7.80, still a relatively high level. We're seeing a mixed picture on commodities, but that says we see actually a relatively flat US dollar on the day, but certainly not on the week. And really the US dollar has been the only place to hide as we look towards the more hawkish Federal Reserve. Remember, we've got Bank of England and the Bank of Japan next week. Notable that the British pound, to mark that anniversary of Black Wednesday, we saw FedEx fall the most since 1980s. We see, of course, the British pound at the lowest since 1985, so we're currently off at a $1.14 level at the moment. We see in the world of bonds, well, a sell everything kind of a mood at the moment. Yields pushing higher over in Asia and Japan ahead of the BOJ, also in Norway and Europe, Katie.
I gotta say, it felt like all the action was outside of the bond market. I guess there was a little bit of a tilt to sell, but if you look at the yields moves today, really not much to talk about. The 2-year yield, not even a basis point there. You look at the 10-year yield, also remarkably unchanged. You did see the 5-year, the 30-year perhaps move a little bit higher. That's the 20-year up there as well, but not much action, maybe because of that triple witching. All of the volatility was in the equity market.
We have to talk, though, I think, about, I guess, the strength of the market or lack thereof here. I mean, we talk about sort of what happens on the headline with the S&P and whether it's back below those key moving averages that we sort of lauded when it broke above it late last week here. But I was looking through this. You got something like 380-something companies in the S&P 500 that are still below that 200-day moving average, and something like 150 of them would need to rally at least 20% to get back to it, something that probably isn't going to happen over the next couple of months.
And talking of valuations overall, many feeling actually that we've seen for once PE ratios forward-looking, lower than the 10-year average, but still no view here that this is the sweet spot. Maybe it's because, as you were saying earlier, Katie, we've got too many alternatives at the moment, and the bond market starts to look attractive, but so do certain asset classes
An
as well.
embarrassment of riches.
But too many alternatives. What's the acronym for that? That doesn't quite roll off the tongue like.
Mania.
It does roll off the tongue.
Does it? Okay.
Oh, totally.
Yeah, the TikTokers will love that.
Important next week is we're going to hear from home builders. We're going to hear from Costco. So we're going to get some good reads in addition to what the Fed says and what kind of color commentary we get from Jay Powell and company. But I do wonder what these companies have to say, particularly about the outlook. Housing's so important to the economy, especially with those mortgage rates higher. And we did see a bump up in that trade today, but I'm curious to see what these companies say.
And we get some of those discretionary names too, including Darden Restaurants, and I think Carnival Cruise. You're a big boat person, girl.
Yeah, I am.
Those are ships. I've been told.
Different kind of
Have you seen
vibe.
Carol's yacht? It's
Do you
like,
know-
it's like a little carnival.
Filling up
carnival
those
cruise.
tanks are expensive. We're sail, so
Celebration.
we just
Is there a swimming pool on your... That'd be
She's got a
amazing.
slide and everything.
A helipad.
Sounds like you've been on it. Oh, all right, all right. It sounds like another team trip. All right, guys, we got to run. Have a great weekend, everybody, on the TV side, and a great weekend to all of our audiences who watch us on the simulcast. We will be back on Monday, same time, same place, wrapping up the Beyond the Bell, though, on this Friday.
This is Bloomberg Business Week with Carol Masser and Bloomberg Quick Takes Tim Stenovic on Bloomberg Radio.
So I know Caroline talked about this earlier. When you look at the S&P 500, you go through all of the names in that index, and you look at the week, the best performing names. She mentioned earlier, Royal Caribbean. Carnival was also one of the best names for the week overall. Norwegian, Wynn Resorts, Netflix, up almost 3% for the week overall. Bottom of the pack, want to guess?
Bottom of the pack.
Talked about it a lot today.
FedEx?
Yep, FedEx down 23% for the week overall.
Who else is down there?
Nucor, WestRock,
Yeah.
International Paper.
Yeah, so those are the paper companies, and then Nucor is the metal company.
Yeah.
And, they're
And Caroline talked about the metals.
there too. Yeah.
We saw metals in the second quarter, the metal industry really fall off a cliff. But they are very important indicators of the economy. So we'll see what happens. Courtesy of Jay Powell and company next week. It's going to be a big one.
It is. Hey, let's get to world and national news. Nancy Lyons is standing by in Washington. Hey, Nance.
Thanks, Tim. Ukraine's President Volodymyr Zelensky wants the world to know the atrocities that were carried out by Russian occupiers. He says a mass grave was found in a city that's been recaptured by Ukrainian troops. Liz Throssell is with the UN's Human Rights Office.
We're aware of reports to which more than 400 bodies were found in a collective grave in Izium. Our colleagues in Ukraine, in the Human Rights Monitoring Mission in Ukraine, are following up on these allegations, and they are aiming at organising a monitoring visit to Izium to determine the circumstances of the death of these individuals.
Liz Throssell says they'll be looking specifically at the method of death. The U.S. is limiting exports of fentanyl and other chemicals to Russia and Belarus. The Commerce Department, in announcing the sanctions, cites the potential for them to aid in military aggression from both countries. Specifically, the department warns the items could be used for Russia's biological and chemical weapons program. The Biden administration is moving to fight cybercrime on the state and local level.
Administration officials are calling on state and local governments to apply for new cybersecurity grants worth $1 billion over 4 years. Secretary of Homeland Security Alejandro Mayorkas says cyber attacks have emerged as one of the most significant threats, targeting everything from gas pipelines to hospitals. Federal officials say every state is eligible for $2 million to develop their own statewide cybersecurity plan. They have 60 days to apply for this first installment. In Washington, I'm Amy Morris, Bloomberg Radio.
Global news 24 hours a day, on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries.
Thank you so much, Nancy Lyons in our DC newsroom. A couple stories we want to bring to your attention. There's a little bit of a connection, kind of.
Yeah, it's all up in the air.
Exactly. We're talking about flying around. SpaceX wants to show the world its Starlink satellite system can deliver Netflix and YouTube at 30,000 feet. So it recently held a demo for the media aboard a jet operated by its first airline customer, the regional carrier JSX. So
This
Elon
is pretty
Musk,
cool.
yeah, getting into
I don't know
in-flight
about you,
entertainment.
Carol.
What?
In the last couple of years, last year, I guess, we've flown cross-country a few times.
In-flight Wi-Fi.
It's sometimes works.
Bummer.
It sometimes doesn't, and it's always
I
expensive.
feel like I always pay for it, and I'm like, where is it?
Yeah, and then I'm like, oh, I guess I can't work. Better go to sleep.
Better go
Meanwhile,
to sleep.
Carol's, printed out 100 sheets of paper and is actually getting work done, and I'm
It's
just
why
sleeping.
I actually print stuff out.
I
'Cause
know.
There's so many times I can't access
It's very
stuff.
smart. Okay, so this was a short jaunt from Burbank to San Jose. It marks the start of Elon Musk's bid to seize in-flight business from satellite providers, including Intelsat and Viasat, that already serve thousands of aircraft. Jeff Seri, president of commercial aviation for Intelsat, which is a leading provider of wireless service on airlines, said, "Are they a serious competitor? Yes." But he says, we do not believe that there's anybody that can beat us.
Yeah, it's different. Starlink, which is part of Musk's space exploration technologies, delivers broadband from a constellation of low-flying small satellites. We've done a lot of stories about this. Business Week has done stories. Lower satellites circle the planet in about 90 to 120 minutes, and that's a departure from the established practice of using a few powerful spacecraft in higher and slower orbits. An upside for Starlink is its signals arrive sooner, so maybe you would actually be able to get Wi-Fi and do some work on the plane, stop watching movies. Wait, we got to do this other story because it's kind of related, but it's not, but it's up in the air. Parent company of Playboy struggling with mounting losses, set to get a boost from the sale of a recently resurrected private jet for $17.5 billion. We're talking about the Big Bunny jet.
Yeah, luxury jet. It's being sold off to raise cash for the lifestyle company that owns and licenses Hugh Hefner's iconic bunny-themed brand, according to a regulatory filing earlier this month. The company is known as Playboy Group, PLBY. It purchased the Bombardier-made private jet for $12 million in 2021, following Playboy's return to public markets.
It's like, hey, let's go take the Big Bunny. Let's go to, I don't know, Vegas or something.
updates, headlines, and breaking news 24 hours a day at Bloomberg.com, the Bloomberg Business app, and at Bloomberg Quick Take. This is a Bloomberg Business Flash.
From Bloomberg World headquarters, I'm Charlie Pellet. Down Friday, Wall Street wraps up a losing weekend. It is on to the weekend. The S&P today falling 28 points, down 0.7%, below 3,900, 38.73. For the week, the S&P was down 4.8% this week. The Dow down this week by 4.1%. Nasdaq this week down 5.5%. Stocks fell, capping the worst week since the market hit its low for the year back in June. FedEx's warning just added to growing concern over outsized Federal Reserve interest rate hikes. Of course, we got that Fed meeting next week. Today, FedEx down 21.4%. Rival UPS today down by 4.5%. The two-year yield 3.86% on this Friday. The 10-year 3.45%. Spot gold up $9 the ounce, 16.74, up by about 0.6%. Bitcoin down 1%, 19,655 on Bitcoin, and West Texas Intermediate crude up 0.2%, 85.28 a barrel. So again, recapping, stocks move lower, losing week as well. S&P today down 0.7. I'm Charlie Pellet. That is a Bloomberg Business Flash.
All right, Charlie, thank you so much. You're listening to Bloomberg Business Week. Carol Master, Tim Stanovic. We've got a really great guest coming up. A little bit of a backdrop. We've got the Nasdaq 100 down about 30% so far this year, down around almost 7% this week alone, amid continued volatility. So we wanted to really talk to somebody who follows the tech space.
Can I call him a friend of the show?
I don't know.
Okay, I'm going to call him
Let's
a
see
friend
how
of
he
the show.
does, and then maybe we'll call him.
Okay, James Chakmak is with us. He's partner and technology analyst at Clockwise Capital. He's with us right now in the Bloomberg Interactive Brokers studio, oftentimes based in Miami. And you join us by phone, but you're up here.
Why are you in New York?
New York for meetings with
Busy
investors and seeing the city. I haven't been here in a while and love it.
Well, welcome back. You used to live here.
Yes.
Are you ready to move back?
15 years. I'm ready to come back much more frequently.
Okay.
I can tell you that one.
He's one of those guys who decamped to Florida during the pandemic.
Oh, one of those.
Yeah, one of those guys. Hey, Meta Platforms is one I want to talk to you about.
Sure.
This is a company headed a 52-week low today.
Mm-hmm.
We love talking individual names with you. You've been in the business for years, so you can speak about pretty much everything. Are the best days behind Meta?
We don't think so. Actually, we did take a very small position in it, just kind of a teaser position to as the company works through its challenges, and in the next couple of months, they will be anniversarying the Apple privacy changes.
Mm-hmm.
So we should start to see what the core opportunities look like going forward. And at the end of the day, it still has 2 billion plus users, global presence, and one of the most important social networking platforms via Instagram. So obviously, some of the news coming out on the Reels information, the engagement wasn't that encouraging, which is.
TikTok. The story is that TikTok is just eating its lunch.
Yeah, TikTok is definitely a risk. But the way we look at it is the valuation is quite low. You're in the low teens. So the risk-reward trade-off is relatively favorable, but we're not ready to stick our neck out. It's still a show-me story at this point.
How patient do investors need to be when it's a show-me story? What kind of show-me story is it?
Well, I think it depends on the strategy. For us, we're able to be patient because we do a lot of options writing on top of it in order to generate income while the position stays within a range. But I think if you're looking to take a much more material position in the company, I think you have to have the fourth quarter results come out and the first quarter outlook. So I think come January is when investors should have a better grasp on the actual opportunities for the company.
Well, and do you think then overall, we've all had a lot of fun with Meta and trying to figure out what Meta is and going forward. And I always make the joke about with climate change, we're all going to be living in the metaverse because we can't live outside. No, but you do wonder, are they just early on in the curve of something that's going to be maybe a big part of our life? Can we even figure that out at this point? Do you fundamentally care about that story as much? Or are you more look at the valuation, look at its user base? There's value in that.
We view it as there's value in the core base and there's optionality, free optionality on the metaverse component. I do think that some of the applications in terms of workplace collaboration, things of that nature, remote work, here to stay in many respects. There will be applications that are more that potentially accretive near term, but really it's just an optionality at this point.
All right, let's talk some other names here. Over at Clockwise Capital, I mean, you guys have separately managed accounts.
Right.
Give us an idea of how you're allocating customers' capital, client capital right now, and what you're bullish on.
Yeah, right now, and it's a really, really tough market. I mean, it's the toughest market in 50 years.
Can I just say you walked in and you were like, whoa, I thought this was going to be a quiet day.
Yeah, today was tough. I mean, you have the FedEx news coming out today. Obviously, I think it's being almost exclusively being read as a macro event, but I do think that there's a component of Amazon logistics, gaining share relative to FedEx. So I think there's some of that in there. But I think you saw from FedEx, what is arguably a complete unraveling of the economy within a 3-month time frame. And, we have no idea what the Fed is going to do. I think the biggest risk is that there's incredible fear that the Fed is going to make a mistake and go too far. We don't know which Powell we have. If we have the 2018 Powell, the one that is data dependent, then we think that rates will stop rising or being increased, after this go around, or maybe a little bit more
after next week's meeting.
Well, I mean, maybe a little bit more at a lower rate through the end of the year, but the last big one being this month, assuming he is data dependent.
Do you have investors, like we've talked about Kathy Wood, who's done a buying spree on some of the pullbacks and kind of doubling down on some of her bets and maybe selling and selling some of those that she's made a lot of money on, as we've seen the markets pull back? Are your investors looking to put more money to work as the markets sell off, or are they getting nervous on concerns that the Fed doesn't get it right?
I think as long as you're hedged as best as possible to the broader market volatility, investors do have sufficient risk appetite and a lot of risk appetite, because you've seen valuations collapse to a point where, I mean, they're below pre-COVID levels, and these are real growth, sustainable businesses. This is not the dot-com bubble. So to answer your earlier question, Tim, how are we allocating capital?
Yeah.
We're increasingly putting greater and greater weights of our portfolio into the emergent cloud-first companies, predominantly like companies like Snowflake, companies like CrowdStrike.
These have been beaten up this year.
Yeah, but we think that those are the asset class within the tech sector that will accrue the greatest proportion of value over the coming investment in near to intermediate term, because of the fact that their growth rates will prove much more resilient than people expect, even against the backdrop of a weakening economy. I mean, you have the economy falling off the last 3 months, and Snowflake was able to put outstanding results in the face of that. So just imagine what these companies can do in a good environment. And we're balancing that out with a much more sustainable or highly visible recurring revenue businesses on the with a larger cap side, like a Microsoft.
James, is a Netflix on your radar at all, which actually saw a bounce this week?
No. The way that we're distinguishing it, we have basically segmented, tech services into 2 buckets. One are platforms, and the other are services. We think that services will increasingly lose value, relative value, and platforms will increasingly gain relative value. Netflix we put in the service bucket, and
they're not a platform?
No,
Is it because they're increasingly have their own content? That's why they're not a platform?
Well, it's not third parties putting their content in order
like
to
YouTube is a platform.
I mean, they're securing third-party content for their first-party customers.
Okay, got it.
So there's no virtual cycle component to it where more suppliers bring more customers and vice versa.
Any opportunities outside of tech?
We also have some exposure into natural gas, which
really?
is, that's just a cyclical macro play. The war, obviously not quite abating. European pressures and rates remaining elevated. So that's one way that we're hedging our book, but really focused on the biggest growth opportunity being those cloud-first companies.
How do you think about this market environment against, I mean, I think at times people have made comparisons to 1999, 2000, I would say it's completely different. But how do you, for someone who has seen a lot of different market cycles, how do you think about this one versus, we don't have the playbook. We really don't know how this all plays out. And I do think you're seeing investors and individuals shift from buying stuff and stuck at home to those pandemic plays to getting out in the world, right? It's just a shift. But how do you think about it?
I mean, it's awful right now because I mean this is the perfect storm. You had the war, you had COVID, you had a complete 180 from the Fed, total uncertainty. You don't know what Putin's going to do, so you have all these potential tail risks in the market. And on top of that, even before this was happening, we're going through one of the biggest technological transformations in history. And these cycles happen like once every 50 years. And these transitions are incredibly painful and take multi-year to develop as we move from old technology to old.
So like EVs? Or,
No,
what,
I mean-
or what are you talking about specifically when you say that?
Like the most simplistic example would be like legacy media to streaming, you know. So it's a huge push-pull. And the problem is even you have the most arguably cutting-edge legacy companies like an Adobe, you know, which is facing huge pressures that had to spend $20 billion in order to move into the cloud.
And got smacked down as a result
and
by
lost
investors.
$20 billion as a result. So there's this huge push-pull, an incredibly difficult transition, and then you have all on these global macro geopolitical risks on top of it. So it's really tough. But we have to, I think what investors need to do is focus on the companies that will define the future, those cloud-enabled platforms, and hold an ample amount of cash. We use with cash. We see it as one of the best hedges.
It's the cloud, stupid.
Yeah, well, you know, there are legacy companies that do have exposure to the cloud.
Right.
Apple, somewhat. I mean, we're not talking Amazon or Microsoft here.
I
IBM.
pay Apple money for the cloud
I do too.
every month.
How do you look at Apple?
I mean, Apple's a platform, no brainer. We
So
own it.
that's one of the legacy companies that can transform itself into a future company.
Yeah, and the thing is, their
got plenty of cash.
customer base is, I mean, it's incredibly sticky. I mean, they're locked in. I mean, where are you going to go? And plus, privacy is increasingly almost a critical differentiator. So I'm never going to switch away from Apple products.
We got to run.
Yep.
20 seconds. If you had one name if you had some new money, one name to commit money to, what would you do right now? Just quickly.
If you have a long enough horizon, I would buy a sizable stake in Snowflake.
All right, gonna leave it there. So much fun. So great to have you here.
Thank you.
Come back
Appreciate
more in
it.
person. We love it. James Chakmak, partner and technology analyst at Clockwise Capital. Usually talk to him when he's in Florida, but lucky for us here in New York.
Also in New York is Charlie Pellet, who's got with us an update on the markets. Hey,
Hi,
Charlie.
thank you very much. Let's begin with the weekly numbers. Losing week, as our listeners well know. S&P this week down 4.8%. The Dow this week down 4.1%. Nasdaq this week down 5.5%. In fact, it was the worst week since the market hit its low for the year in June. FedEx's warning added to growing concern over outsized Federal Reserve interest rate increases. FedEx today plunged 21.4%. Rival UPS lowered today as well, down by about 4.5%. S&P dropped 28 points today, ending the week at 3874, below 3,900, down 0.7%. The Dow today down 139, down 0.5%. Nasdaq Composite Index down 104. That was a drop of 0.9%. The inverted 2-year 3.86%. The 10-year 3.45%. Spot gold up $10 the ounce to $16.75, up 0.6%. And West Texas Intermediate crude up 0.3%, 85.31 a barrel. So as we wrap up this week, we are looking ahead to next week. There is a Fed meeting. Brian Railing is head of global fixed income strategy at Wells Fargo Investment Management, and he was a guest right here on Bloomberg Business Week.
I do expect that inflation expectations and eventually inflation over the intermediate to long term will go down. I believe that the Fed will win its war and will hit its targets. Now, not over the near term. There's going to be a lot more, I think, fear around inflation, a lot more work the Fed's going to have to do, but I think the Fed will do the work that's required.
General Electric shares declined today after the manufacturer's finance chief warns supply chain challenges are weighing on the company's third-quarter performance. GE today down 3.7%. Briefly, Credit Suisse Group is considering reviving the First Boston brand as the Swiss lender seeks ways to boost the fortunes of its beleaguered investment bank. This according to sources. I'm Charlie Pellet, and that is a Bloomberg Business Flash.
It is indeed. All right, Charlie, thank you so much. Well, the cover story of the new issue of Bloomberg Business Week, we talked about it yesterday, about the Chinese spy who wanted GE's secrets, but the U.S. got China's instead. It's a great read, so check it out. But Chinese espionage, and for that matter, U.S. espionage, nothing new. Surveillance of other countries, also not new. But when it comes to domestic surveillance, Tim, a country like China seems to take it to a whole other level.
Yeah, we got with us this afternoon Josh Chin. He's Deputy China Bureau Chief. He joins us on the phone from Park City, Utah, a Deputy China Bureau Chief for the Wall Street Journal. He's also the author, along with Lisa Lin, of Surveillance State, Inside China's Quest to Launch a New Era of Social Control. Josh, great to have you this afternoon. How are you?
I'm great. Thanks for having me on.
So give us an overview of the power that China has when it comes to its surveillance state. Like walking down the street in certain areas of the country, how are you being watched?
Right. So if you're walking down the street in China, especially these days with COVID, you're being tracked in any number of ways. There are cameras with facial recognition capabilities that can pick your face out of a crowd. Cameras can identify you by the way you walk. There are microphones that can grab your voice. And these days, everyone's walking around with a COVID health tracking app in their pocket that tracks where they've been and how they've been exposed, whether their level of exposure to COVID.
Right. And so a lot of things being tracked. And Lisa, both you and Josh kind of cover this world and different aspects of the book. And I want to get into it with you because Lisa, excuse me, I want to get into what was the story and the reality that you were looking to tell in terms of the area that you really cover. And you cover a lot of U.S. business and Chinese topics. You look at Silicon Valley. So what is it that you wanted to tell when you guys set out to do this book together?
Yeah, on my part, I guess I didn't set out to tell this, but in the process of research, I had some really interesting findings. And one of the findings was really how, U.S. tech companies, particularly those in Silicon Valley, pioneers such as like Sun Microsystems and Cisco, they were one of the first building blocks of the Chinese surveillance state. Back in the year 2000, when China held one of its first public security expos, and the police was there to basically look at what companies had on offer. It was mainly Western companies that were selling their systems there to them. It didn't, and I guess to kind of summarize how impactful some of the U.S. companies were, Sun Microsystems ended up selling China its first fingerprint database.
Wow.
Which is a sizable project for a country the size of China. Fast forward to today, what Josh and I did was we poured through several Chinese government contracts, particularly those looking at the surveillance systems bought by police. And what we realized was U.S. companies now weren't selling systems, but they were selling components, like parts that built the surveillance state. So one example would be, and they were selling everything from low-end hardware like hard disk drives, because video surveillance requires a lot of storage, to things like cutting-edge chips, graphic processing units sold by NVIDIA, like GPUs, which originally were built to power gaming, but actually we found that they're great for deep learning and all the AI applications, like facial recognition, for example, that can recognize Uyghurs or people of interest in China.
So ultimately, the limits, right, that the U.S. has been imposing on the likes of NVIDIA and AMD to prevent them from selling into China, Lisa. So this is something that could ultimately impact China's ability in terms of surveillance of those folks that are in the country.
Yes. In theory, the supply chain is very opaque. There are all sorts of ways and means that Chinese companies can get around, being on a trade blacklist, for example, or buying restrictions. And I'll probably point you to an example of a Chinese company called SenseTime. SenseTime is China's largest AI surveillance company, and SenseTime is both on the entity list, the Commerce Department trade blacklist, and it is on the investment blacklist. So U.S. investors cannot legally they're not allowed to be trading or investing in SenseTime shares. What we know, though, from the start of this year, when SenseTime tried to list in Hong Kong, they actually told investors that they weren't impacted by the entity list at all. And that was because when SenseTime was put on the entity list, it was one entity. It was this Beijing entity that was put on the list. So SenseTime has multiple entities in like Shanghai, Hong Kong, and these entities were free to buy the type of like high-end U.S. technology that the entity list was supposed to block. And in addition to that, when SenseTime tried to IPO, SenseTime is a company that has a ton of U.S. investors making up its investor base, like people like Fidelity Capital, Silver Lake. When they were put on the investment blacklist, again there was a legal loophole. Essentially, the entity that was put on that investment blacklist was the Hong Kong entity, and the entity listed in Hong Kong was a Cayman Islands one. So through very smart maneuvering of where the entities are based, they managed to get around these restrictions.
Right. I mean, you guys have done a deep investigation into all this. We've got to take a break, do some news, but we want to come back because what I want to get into is, what our audience, a smart audience, an investing audience, that you guys are very familiar with, what they need to understand about what's going on in terms of Chinese domestic surveillance, Tim.
Yeah, and I really want to dig into one area of the country, the Xinjiang region. And people who listen to our program and have read up on this are familiar with the region when it comes to the way that China has treated the Uyghur population there. So we'll specifically ask about what are they doing in order to continue to repress these people.
Right, exactly. We're going to come back with Lisa Lin. She's China correspondent at the Wall Street Journal on the phone in New York. Josh Chin is Deputy China Bureau Chief joining us on the phone from Park City, Utah. So we'll get back to him in just a moment. In the meantime, let's head out onto D.C. and Nancy Lyons for a check on World and National News. Hey, Nance.
Thanks, Carol. A mass grave in the Ukrainian city of Izium with more than 400 bodies appears to mark the latest atrocity uncovered by the retreat of Russian forces. White House spokesman John Kirby spoke about it today.
And it's horrifying. It's repugnant. And sadly, it's in keeping with the kind of depravity and the brutality with which Russian forces have been prosecuting this war against Ukraine and the Ukrainian people.
Again, John Kirby, the coordinator for strategic communications at the National Security Council. There is a new concern about COVID-19. As Bloomberg's Nathan Hager reports, it could put seniors at greater risk of developing Alzheimer's disease.
Researchers at Case Western University School of Medicine looked at the health records of more than 6 million Americans over the age of 65 who had recovered from COVID. They found for every 1,000 seniors with the virus, 7 will be diagnosed with Alzheimer's within a year. That compares to 5 per 1,000 for non-COVID seniors. The study in the Journal of Alzheimer's Disease does not show COVID causes the brain-wasting disease, but it does suggest doctors track older patients for memory loss after they recover from the coronavirus. In Washington, I'm Nathan Hager, Bloomberg Radio.
The line to see Queen Elizabeth II's coffin is so long, officials had to institute a pause for 6 hours today. These women are still hanging in there.
Queue to get into the queue. Yes, it seems that way. We're still smiling.
The wait for those in the line is now more than 24 hours. King Charles III and his siblings stood vigil earlier today. The funeral for the Queen is set for Monday. Global news 24 hours a day, on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Nancy Lyons.
All right, Nance, thank you so much. Carol Massar, Tim Stenovic, live in our Bloomberg Interactive Brokers studio on this Friday, streaming on YouTube. This story that we want to tell you about, share with you, is among the most read on the Bloomberg terminal. It has to do with Russian President Vladimir Putin.
Yeah, he threatened to step up attacks on Ukraine's civilian infrastructure, vowing to continue his invasion after his forces suffered some of their worst reverses in the 7-month-old campaign. In his first public comments on the issue since Ukraine said it retook as much as 1/10 of the territory Russia had seized, Putin was dismissive of the counteroffensive. Here's what he said, quote, "We'll see how it goes," and he noted that Russian forces are continuing to advance in other areas.
Yeah, just recently the Russian armed forces hit some sensitive targets. Let's consider that warning strikes. This is what President Putin told Russian media reporters today. Earlier today, he was attending a summit of the Shanghai Cooperation Organization, which is a China-led bloc. We know that Putin and President Xi have been meeting their first face-to-face since COVID. So it's been, we've been following the communications and conversations between the two. President Putin going on to say, if the situation develops further in this direction, our response will be more serious. And again, he's talking about what's going on with Ukraine.
Yeah, Ukraine wrested control out of a large swath of the northeast of the country occupied by Russia in a lightning offensive this month that forced Russian troops to flee, abandoning their equipment. The sudden losses dealt a major blow to the Kremlin's efforts to seize eastern Ukraine.
It's the back and forth on this is pretty interesting. I'm thinking about UN General Assembly and all of the issues that we're dealing with. We do want to point out that President Putin's comments coming just hours after he had told Narendra Modi that Russia would, quote, do everything to end this as soon as possible. The Indian Prime Minister chided the Russian leader, saying, quote, today's era is not one for war. And he got some pushback from President Xi, safe to say, too, earlier in their conversations.
Yeah, that's a really good point, Carol. Also in his comments to reporters, Putin reiterating his claim that he's ready to negotiate with Ukraine, but blamed Kyiv for being unwilling to talk. Ukrainian officials have demanded a full Russian withdrawal as a condition.
All right. Well, certainly something we're watching with everything else that's going on in this world. Check it out, though, at Bloomberg.com to read that full story. You are listening to Bloomberg Business Week. We'll come back with our guests in just a moment.
Tune into Bloomberg Wall Street Week with David Weston tonight at 6 p.m. Wall Street time on Bloomberg. David speaks with Aldra Management CEO Dan Chung and former Treasury Secretary Larry Summers. Wall Street Week tonight at 6 on Bloomberg Radio. .445 on Wall Street, time for drive time traffic. We do it every 15 minutes right here on Bloomberg Radio. Ed Kalagi, the Gowanus Expressway. What's going on?
Tim, there is an accident eastbound of the Gowanus at 38th Street. The right lane is blocked. Lanes back from the Fort Hamilton Parkway area. On the westbound side, you've got a very heavy ride of 45 minutes on the BQE from the LIE down towards Atlantic Avenue. Traveling in Manhattan, still that very heavy ride both sides of town. It doesn't let up. You've got the west side slow, mid-50s all the way on up. Two-way delays on the FDR from about the 20s to the RFK Bridge. Mix in the UN General Assembly into that equation. You've got at least a half hour to come up the Harlem River Drive. Holland Tunnel 50 out, 15 in from 1 to 9. 40 out, 20 minutes into the Lincoln Tunnel. And you had slow upstairs and downstairs getting over the George Washington Bridge. Bloomberg 1130, three-day weather. Tonight, partly cloudy, lows 60 to 65. Saturday, partly sunny, highs near 80. Sunday, partly sunny, high 85 to 90. And Monday, a chance of showers and a high 80 to 85. Right now in Central Park, sunny, we are at 77 degrees. It's the energy savings event at Lowe's. Save energy and money. on select major appliances, including Whirlpool. Selection varies by location. Exclusions apply. Visit Lowe's.com for details. Valid through 9/28. With the best ride in and out of the city, I'm Ed Kalegi, Bloomberg 1130. Bloomberg Business Week continues.
Markets, headlines, and breaking news 24 hours a day at Bloomberg.com, the Bloomberg Business app, and at Bloomberg Quick Take. This is a Bloomberg Business Flash.
I'm Charlie Pellet. Worst week for the S&P 500 index since June 17th. Nasdaq 100 had its worst week since January 21st. Stocks declined today as FedEx's warning added to growing concern over outsized Federal Reserve interest rate increases. The S&P today down 28, ending the week below 3,900 at 3873, a drop there of 0.7%. The Dow down 139, a drop there of 0.5%. Nasdaq down 104, a decline of 0.9%. The inverted 2-year 3.87%, the 10-year 3.45%. Spot gold up almost $10 the ounce to $16.75, up 0.6%. Bitcoin today down 0.6%, $19.73 the ounce, and West Texas Intermediate crude up 0.3%, $85.32 a barrel. FedEx plunged 21.4% after last night's warning. UPS also falling today. It was down 4.5%. I'm Charlie Pellet. That is a Bloomberg Business Flash.
Hey, thanks so much for that update, Charlie Pellet. I want to get right back to our next guest. They co-wrote the book Surveillance State, Inside China's Quest to Launch a New Era of Social Control. The book is out now. It's Lisa Lin, China correspondent for the Wall Street Journal, who joins us on the phone from New York, and also Josh Chen, Deputy China Bureau Chief, on the phone from Park City, Utah. Hey, Josh, I want to get into how this is all playing out in Xinjiang, which a remote Asia frontier, of course, where we know that the country is oppressing the Uyghur population. What does it look like there?
Right. So, Xinjiang it's a massive area, about twice the size of Texas, in the far northwest of China. It's very rich in resources, and has also long been a sort of difficult place for the Communist Party to control, and that's because it has a large population of Uyghurs and other Turkic Muslims who really chafe at Chinese rule. And so, for about the past 5 years or so, the Communist Party has been running what is best described as a sort of campaign of forcible assimilation, using surveillance technology and a network of internment camps. And I first went there, discovered some of this in 2017, in late 2017. At the time, no one really knew what was happening there. I've been a China correspondent at that point for more than a decade, and what I saw there was just one of the most shocking things that I've seen in China. And essentially, if you were a Uyghur in Xinjiang, you are subject to constant, pervasive, suffocating surveillance. Right. So if you go to a bank or a market or a hotel, any public place, you have to scan your face and your ID card. If you want to buy gasoline, you have to make everyone get out of the car. Again, scan your face and ID card so they can track how much gasoline you're buying. In one place, if you want to buy a knife, they would take your ID information, all of your home address, and they would laser etch it into the knife in the form of a QR code. And then they collect data on things like how often you pray, how often you go to the mosque, do you own a Quran, what sort of movies and music and apps do you have on your phone, and they essentially collect all of this data to track and then sort Uyghurs according to how much of a risk they might potentially pose to the Communist Party's rule in the future. And then those who are considered risky are sent to camps to be subject to re-education. And so it really is a pervasive, just sort of unprecedented campaign that they're running out there.
One thing I wanted to ask you both, because I do think it's funny, we were just talking with an analyst who follows James Chakmak, the technology world, and talking about we are in this really critical phase of major disruption innovation that we don't see often in our world. And maybe that's explaining also some of the kind of discomfort within the financial markets overall. But I do wonder about what is the next phase for China? President Xi very much out there front and center, wants to lead on higher tech, doesn't seem to care who he maybe ticks off, in particular something like the United States in the process. But I mean, it's a complicated relationship between the two. But I do wonder, what is the next phase of China? One that obviously will surveil its population very closely. I mean, Josh, how do you see it? How do we need to think about China going forward? When many people, I feel like investors included, will say that's going to be one of the big macro themes overall for the world, geopolitically, market-wise, economically.
Right. Well, what's happening in China, I think you're already seeing sort of the future of China with the COVID pandemic.
Right.
With essentially, in the past, kind of that pervasive, just suffocating surveillance was pretty much limited to Xinjiang. Now with the COVID pandemic, those systems and those approaches and those technologies have all spread to basically cover the entirety of China. Right. So now you have massive real-time surveillance of everyone in the country, and it's clear that Xi Jinping is willing and able to use those technologies to exert a tremendous amount of social control, very tight control. Earlier this year, you had the Shanghai lockdown, for example. The wealthiest city in China, not used to experiencing this sort of thing, and they were outraged. But the Communist Party has persisted with zero COVID, and I think that's partly because they're confident that these new tools give them the ability to control the situation and the economy of society in China in ways that they haven't before.
So,
and there's no signs that that's going to change.
So, Lisa, come on in and layer on top of what Josh said. I mean, how do you, I think about our audience and the Wall Street Journal audience that you guys, work with, how does the world kind of need to think about China in the next, 10, 20, 50 years?
Sure, and I'll probably talk about it from the company perspective.
Sure.
And this is already happening. We're not going to have to wait 10 or 20 years to see this happen. I would put it this way. In the past 2 decades, U.S. and Western companies have had very blind optimism on the risk of operating in the Chinese market, right? So 10, 20 years ago, China was seen as this easy place for profit. Commercial priorities overshadow any sort of deep thinking about the possible human rights abuses that could happen. In the boardrooms, you'd be hearing people talk about how fast you could expand in China, and what was the best way to get your product out in the market. In the last 5 years, we've actually seen more like a paradigm shift in the way U.S. companies are approaching China. We're seeing in the last few years more and more reporting about the atrocities in Xinjiang. And now that the U.S. government's actually trying to react to China's human rights issues with like trade policy, not just foreign policy, we're definitely seeing U.S. companies become more cautious about the risk and less like bushy-tailed and starry-eyed about the potential of China. So now what U.S. companies are actually discussing in boardrooms would be how do we mitigate the risk of being in China? Is there a supply chain risk? Would our products go through, would our products be exposed to forced labor in the system? Or will we be potentially working with someone who could be slapped with a ban, for example?
Right. So we have to jump in, and unfortunately, we're running out of time. But you're right. The conversation has gone from mega opportunity to a lot more about risks about your exposure to China. We've got to run. Lisa, thank you so much. Lisa Lin, China correspondent at the Wall Street Journal, along with Josh Chin, Deputy China Bureau Chief at the Wall Street Journal, both of them. The new book, Surveillance State, Inside China's Quest to Launch a New Era of Social Control. Before we go, do want to thank Carly Wana of our Bloomberg team. Cool thing we do here, our reporters, especially those who are new and stuff, they get to do different times with different groups, a rotation, and she's been with us for the last 3 months, has become an integral part of our Bloomberg Business Week team, working on The Daily Show, on our weekend podcast and radio show. She's going off to work on another team here.
Yeah, she's doing crypto, but she's going to be back on our airwaves as soon as she gets some stories out on the crypto team. So we're looking forward to that.
Yeah, she's pretty incredible. Like the rest of our Bloomberg Business Week team, which we thank, help us get it together on a daily basis, on a weekly basis. Have a great weekend. Check out our weekend podcast and our broadcast on Bloomberg Radio. Stay safe, everyone.